Good afternoon. It's just on 2 o'clock, so I will start so long. This afternoon is the last SURF webinar for 2021. And what we will cover today is some performance, but with a specific focus at the end on ESG, on environmental, social, and governance factors. And my colleague, Nikki Davidson, will take us through the 2021 Sygnia Sustainability Report. So on the agenda for today, I will quickly go through the default investment strategy of SURF. I will go through the performance as well as the Alexander Forbes surveys. I will quickly touch on ESG and why it's becoming increasingly important in a retirement fund context. And then I'll hand over to Nikki, who will take us through the Sygnia Sustainability Report for 2021. Before we get into the numbers, I just want to remind you what our mission and vision is here at SURF. Our mission really is to restore confidence in the retirement fund industry through innovative products and services that make it easier for our members to save and plan for a comfortable retirement. And our vision over the long term is really to enable life-changing and dignified retirement outcomes and to build a more financially secure future for all South Africans. The default life stage model for SURF follows a 6-year glide path. So essentially all members from their early 20s or as early as they're able to start working, right up until 6 years before they retire, will be invested in a more aggressive portfolio, in one of the 70 portfolios. And then 6 years before retirement, we start transitioning them to more conservative portfolios with more bonds, more cash, lower risk type of portfolios, until 1 year before retirement, they're sitting in the 40 portfolio. Just a reminder of what the numbers in the portfolio names mean. If you look at the 70 portfolio, about 70% of that portfolio is invested in equities, whereas the 40 portfolio would have about 40% allocated to equities. So that's the glide path of the life stage model. And within every participating employer in SURF, the management committee then chooses whether they want to follow the skeleton range, the signature range, or the synergy range. The difference between all three of these ranges is that the skeleton range is 100% passive, so it's low cost, passively managed. The signature range is a blend between active management and passive management. And the synergy range is also a blend between active and passive, where you have the local portion being actively managed by South African active managers, and then the global portion is passive. And actually, the global portion of all three of these ranges is exactly the same. There's also a difference in the approach of these ranges, whereby the skeleton and the signature range is what we call a specialist approach. So it means that Sygnia controls the asset allocation of the skeleton and the Sygnia ranges. So if you look at this diagram on the left, if you have the portfolio, if you think about the 70 portfolio, our modeling tells us what percentage should be invested in equities, what percentage should be invested in bonds, what percentage in cash, and we have that modeling across all asset classes. And then within equities, say for example, in the 70 portfolio, our modeling tells us that about 48% should be invested in equities. We then look for the best equity managers, and that could be a passive or an active strategy. In the bond space, say for example, about 15% should be invested in bonds. We then look for the best way to access bonds. It could be a blend, it could be just passive or just active, depending on the model. In the skeleton range, of course, all of these would be passive strategies, and the signature range, it would be a blend between active and passive. The balanced approach is quite different. So what happens in the synergy range is you have your portfolio, say for example, synergy 70. You then divvy up that portfolio between a number of active managers. So you'll give a portion to Alan Gray to manage, a portion to Coronation to manage, and then these managers then decide on the asset allocation. So it's up to them what split should go to equities, to bonds, to cash, to property. So that's really the difference between the specialist and the balanced approach. So just again, the skeleton and the signature follow the specialist approach, and the synergy range follows the balanced approach. And the offshore portion of all three ranges is the same. From a risk and return perspective, if you look at risk on the horizontal axis and return on the vertical axis, we can see that the 70 portfolios do take on more risk. They do have more invested in equities. Equities is a risky asset class, but we know from investment theory that the higher the risk, the higher the return over the longer term. Whereas closer to the left, you have your safer type of portfolios, like the money market. If you invest in cash, if you put your money in the bank, you don't expect it to, have any sort of volatility to go up and down from one day to the next, but you also don't expect this very big growth over the long term. So in order to have inflation-beating returns, we do need to take on some risk, and that is why the most appropriate portfolios for younger members are the 70 portfolios. So how have these portfolios performed to the end of October? So if we're specifically looking at the one-year numbers, but even across all periods shown on the slide, we can see nice, good, positive returns. We don't see any minuses, which is great. The markets have had a nice bounce back, and especially over the 1 year, we can see that the 70 portfolios have all done really, really well, and every single one of them is ahead of the strategic benchmark. The 60 portfolios also doing really nicely ahead of the strategic benchmark, likewise for the 50 and the 40 portfolios. And all of these portfolios are comfortably ahead of inflation, which was measured at 5% as at the end of September. So all doing really nicely against both benchmark and the inflation plus targets. It's always nice to look at the cumulative performance over the long term. So what we're having a look at on this slide is how 100 Rand invested once would have grown since May 2012. And what we can clearly see is whether the investment was in the Synergy, the Skeleton, or the Signature range, this 100 Rand definitely would have grown in every single one of these three ranges. But what's also quite evident to see is that this 100 Rand did not grow smoothly. We do expect volatility along the way. When we're investing in equities, we do know that share prices go up and down. They are very volatile, but over the long term, they do provide good growth in the portfolios. So we can see that they have grown nicely with some volatility along the way. And what's quite pronounced is we can see the first quarter of 2020 when the COVID crisis hit, when all countries around the world went into lockdowns, a lot of the markets fell at that stage. So we can see that, fast drawdown and that, quite quick recovery afterwards. What we can also see is that all three of these red lines are comfortably ahead of the black line. The black line is the Global Large Manager Watch median, and how it's calculated, it's the median performance of these managers listed at the bottom. As you can appreciate, all of these managers listed at the bottom are very large, very well-known South African asset managers. They have been managing retirement fund assets for a very, very long time, so they're very experienced in the space. So it's well accepted in the industry that if your portfolio can outperform the median, then you've done better than the average retirement fund, and your portfolio has done very well. And we can clearly see that all three of these ranges have done really nicely against the Global Large Manager Watch median, which is very nice to see. Now, if we look at the surveys, Alexander Forbes prepares these surveys. They do compare like-for-like portfolios. What you really wouldn't want to compare is a very high equity portfolio with a low equity portfolio. It wouldn't be a fair comparison. So the way that the surveys are structured is that portfolios are grouped into categories based on their equity allocation. So what I have in front of you right now is the low equity multi-manager survey. So all of these portfolios are low equity in nature, having about 40% invested in equities. Now, something else to focus on specifically in a retirement fund context is we always need to be focused on the long term. We are not investing in a retirement fund for 6 months or for a very short time horizon. We really need to be invested in these portfolios for the long term. So it's very important to focus on longer term performance and not to focus on the shorter term volatility. So over the 1 year, what we can see is that the Synergy and Signature range are somewhere in the middle of the peer group, whereas over 2, 3, 5, 7, and 10 years, we can see that all three of these ranges have done very, very nicely, with the Signature 40 portfolio being the best performing over the longer term. The next category is the low to medium equity category. So all of these portfolios have low to medium allocation to equities, about 50% allocated to equities. We can see that over the 1 year, all three of our ranges are underperforming some of our peers, but over the longer term, we can see that performance is, the good performance is consistent. There are reasons for the shorter term underperformance, which I'll touch on when I get to the 70 portfolios, but we can see that over the longer term, all three ranges have done very, very nicely, with the Signature 50 fund being the best performing over 10 years in this category. The medium equity survey, again, over the 1 year, we are underperforming some of our peers, but over 2, 3, 5, 7, and 10 years, again, these portfolios are comfortably outperforming a lot of the peers in the markets and are some of the best performing portfolios. And then probably the most important portfolios are the 70 portfolios. The reasons why I say that these are probably the most important portfolios is we do expect members to spend the majority of their working lives being invested in the 70 portfolios. Now, over the 1 year, again, we can see the Synergy 70 fund doing quite nicely, somewhere, in the middle to the upper half of, performers, whereas the Signature and the Skeleton range is closer to the bottom. Now, the reasons for the underperformance over the shorter term, in a retirement fund context, the 1 year is the shorter term. So the reasons for the underperformance is that we have been slightly more conservative than some of our competitors over the 1 year. So we have held a little bit less of South African equities. And over this specific 1 year period, South African equities have done very well. The second reason is that we have had no direct exposure to property, to the South African property market. And property has done very, very well. As at the end of October, property is up about 65%. So some of our competitors that have had a higher exposure to equity and to South African properties have, of course, outperformed over this period. However, if you look at property over the last 3 years or 5 years, it's still a negative returning asset class. And our portfolios have been rewarded for avoiding property over the longer term. So we understand where the shorter term underperformance comes from, and especially in the 70 portfolios, it is really important to focus on the longer term numbers. And if we look at the survey over the last 5 years, we can see that the Synergy fund has been the best performing, with the Signature not that far behind, less than 1% behind at 9.8%, and the Skeleton at 9.5%. Over the 7 years, all three ranges just behind one of the old mutual portfolios. And then over the 10 years, the Signature 70 portfolio has been the best performing in this high equity multi-manager survey. The way to interpret the longer term numbers, if you look at this return of 12.5%, this is an annualized return. So had you been investing in this portfolio for the last 10 years, your return would have been 12.5% per year for the last 10 years. And then the last thing to mention about these surveys is that these are gross of fees. So fees are really important, especially if you compare the Skeleton range against some of its competitors. The Skeleton range is totally passive. It's a low cost portfolio. So on a net fee basis, the performance would look a lot better against a lot of the more expensive portfolios out in the market. So overall, despite the shorter term, the 1 year peer relative underperformance, the portfolios have still done very well, as you saw in the first slide, comfortably outperforming their own benchmarks as well as their CPI plus objectives. Always interesting to have a look at the performance relative to the single managers. Not always a fair comparison, but just interesting to have a look at how these very well diversified multi-managed type of portfolios perform against the single managers. Remembering that some of these single managers actually do form part of these portfolios. And over the 1 year, we can see that, Coronation has done phenomenally well, in fact, across all of these periods, but the Synergy fund is right up there with some of the best single managers. And even the Skeleton and Signature range have managed to outperform Standard and Stand-up over the 1 year. Over the 2 years, it's only really Coronation that has managed to outperform these portfolios. Most of the other managers have underperformed. Likewise, over 3 years, it's only really Coronation at the top of the ranking tables, with all 3 of these life stage portfolios outperforming all these other single asset managers. And then the picture doesn't change too drastically over 5, 7, and 10 years. And interestingly enough, over 10 years, we can still see that it's only really Coronation in 91, and both of these managers are in Synergy as well as in Signature, have outperformed the skeleton portfolio. We can see that a lot of single managers have struggled over the longer term, and on a net to fee basis, again, this picture would look very, very different, as we know that the skeleton 70 portfolio is a very low cost portfolio, as I mentioned. Now, up until this stage, we've spoken about performance, and it's all good and well that we look at performance in absolute terms, so we just look at that number. But it's also important to consider the risk that a portfolio is taking on. And again, if you look at risk on the horizontal axis, risk is measured by standard deviation. The further right you look, the more risk a portfolio is taking on. And then the return is on the vertical axis. So essentially, for every level of risk, you would want the top performing portfolio, something that plots at the top. So looking at Synergy 70, for example, taking on just about 10% of risk. For this level of risk, we can see it is the top performing portfolio. Likewise, for Signature 70, just about 9% of risk. For this level of risk, it is the top performing portfolio. And overall, all 3 of these life stage ranges have done really well. We can see on this risk return scatter plot. Another way to interpret it is if, for example, we're looking at Signature 70, anyone that plots underneath this Signature 70 block, you can say that they've taken on the same amount of risk, but simply have not been rewarded for that risk taken if you look at their corresponding return on the y-axis. And these portfolios to the right, a lot of these portfolios are actually quite high in the shorter term ranking tables. They have taken on even more risk than Signature, than Synergy, than Skeleton 70, but they simply have not been rewarded for that risk taken over the longer term. How have these portfolios taken more risk? It means that they do have a higher allocation to equities. They do have a higher allocation to hedge funds, to property, to all of these riskier asset classes. So that is all I'm covering today in terms of performance. Now, as I mentioned to you earlier, today's focus is on ESG. Now, ESG, E stands for environmental, S stands for social, and G stands for governance. And ESG investing is really a class of investing that's also known as sustainable investing. So it's all about companies doing the responsible thing when considering these separate factors, when considering the E, the S, and the G. Now, the E is important because we do expect companies to be good for the environment, to not pollute, to, really try use clean energy as much as possible. And this is not just important from a feel-good perspective, but even from a performance perspective. You wouldn't want a company, if you invest in a company that's suddenly in the news because they are polluting the environment, you can imagine that it will affect their share price. So more and more public awareness around climate change, which has been very, very topical, especially right now, coupled with issues around, resource scarcity, they really have increased both individuals and institutions focused on ESG. And there was a poll of professional investors that said that they do believe that specifically environmental factors are most likely to drive investment return over the coming years. So it really is important that, when we invest in companies, or when our asset managers invest in companies, they do focus on ESG, and this is why the E is important. It's all about the environment. The S is all about the social aspects. And what are the social aspects? Well, the social aspects is all about how a company treats its employees, how they treat, people around the community. It's all about the, public opinion of this company. And again, you can imagine why these factors are important. Again, if a certain company had to be on the news because of unfair practices, and if we had to see the staff of a certain company constantly striking about a certain issue, you can imagine that it will affect their share price, it will affect their, the public perception of that company, and it wouldn't be, potentially a very good investment over the long term. Companies also need to provide a safe and good working environment for their employees. And again, these types of risks can affect the perception of the companies. And then the public opinion, as I mentioned. Really, really important, as these public opinions do drive, the thinking around, whether investors, view this company positively or negatively, which in turn will affect whether they want to buy this company or sell this company, and then that will affect the share price. And then governance. Governance is really, really important. And if you think, a couple of years back, the Steinhoff scandal was all about governance, about, funny accounting, and, poor governance, again, can really lead to a bad, share price of a company. So, you could invest in company with bad governance, and suddenly something comes to the fore that we never knew before, and, a scandal blows up, and that share company, drops a lot. A good example of this is the Volkswagen emission scandal. So a couple of years ago, I'm not sure if you'll recall, but VW did have an emission scandal, and that really affected their share price quite drastically. So governance factors are, the G in ESG, and again, very, very important to focus on the G when it comes to, assessing whether a company is doing the right thing. In S&P, their global research has shown that companies that rank well below average in good governance are particularly prone to mismanagement and risk their ability to capitalize on business opportunities over time. So the G, very, very important. Now, ESG collectively, as I mentioned, has become increasingly important. It's important for, individuals that want to align their investments with their personal values. It's very important for institutions, and it's become increasingly important for retirement funds. Now, there are a number of different guidelines for responsible investing, and some of these are embodied in Regulation 28 of the Pension Funds Act. And Regulation 28 really tells us how we can invest retirement fund assets. And Regulation 28 states that, these environmental, social, and governance considerations need to be taken into account when devising an investment strategy for retirement funds. Then there's also principles that are embodied in the Code for Responsible Investing in South Africa, which is known as CRISA for short. Then there's also principles that are in the United Nations Principle of Responsible Investment. There was a guidance note issued in 2019, also specific to retirement funds and how they need to, incorporate ESG into the investment policy statements, and responsible investment and ownership guide for pension funds in South Africa. So there's a number of different guidelines that specifically focus on ESG and retirement funds. CRISA has 5 core principles, and they really are all about considering and incorporating these good sustainable practices. And guidance note 1, which is specific to retirement funds, really does state that in the investment policy statements of retirement funds, the trustees need to say how they have considered ESG when devising their investment strategy. And then the second element is all about the appropriate disclosure and reporting of ESG. And now that I've given you a little bit of an introduction to ESG, I want to hand over to my colleague, Nikki Davidson, who will take us through exactly what Sygnia is doing with regards to sustainability. So what she will take us through is the Sygnia Sustainability Report for 2021. Thereafter, we will answer some questions. Thank you.
Thank you, Eva. Just give me a few seconds while I pull up my screen. Okay, thanks so much. And thank you for that great introduction to the background of ESG and responsible investing. For the second part of today's webinar, I'm going to be giving some feedback on how we are integrating ESG in our investments at Sygnia and what this has looked like over the past year. So definitely over the past year, we saw an increased focus on the S, or the social element of ESG investing, particularly relating to the COVID-19 pandemic. It's really increased everyone's awareness of ESG investing and just how important it is to address these risks. And then earlier this month, we also had the COP26 conference in Glasgow, and that conference was all about how we are addressing climate change, and that's again brought the climate crisis front of mind for investors and just in society. So definitely ESG risks and opportunities are something that certainly can't be ignored anymore, and that's why we integrate such factors into our investment process. So this slide gives an overview of how we are integrating ESG into the portfolios. The way we do this would differ depending on the asset class and depending on the structure, whether it's internally managed or whether, as part of our multi-manager portfolios, we delegate some of the mandates to external managers. So each one of those approaches looks different. And this slide kind of gives an overview of what we do in each category. So starting off by looking at our multi-managed products. So this includes something like the signature range, the skeleton range, and the synergy range. When we appoint managers, we ensure that they have documented ESG policies in place. And we also look for evidence to adherence of those policies. So this might take the form of proxy vote records or evidence of engagement with the companies in their portfolios. Then when it comes to the passively managed equity portions of our funds, we typically manage those in-house, but the proxy voting on these equities is done in collaboration with our external asset managers. And then if we take a look at the credit and infrastructure components of our multi-manager products, ESG forms part of the initial credit review whenever we make kind of an investment in this asset class. And we also are very active in engaging with the industry and engaging with data ranges when it comes to new instruments such as green bonds, social bonds, and transition bonds. Then we have also launched a number of products that have specific ESG targets or mandates. So these are typically international products, and they also sit within our international building blocks. So the signature, skeleton, and synergy range would all have exposure to these products within those building blocks. And then the second to last point there is shareholder activism. That just relates to, Sygnia has a long history of shareholder activism. We've addressed governance shortcomings in the industry when they occur, and that is something that is kind of core to Sygnia. And then lastly, we also collaborate within the industry. So we collaborate with industry bodies such as CRISA and ACISA to help advance responsible investment within the South African asset management landscape. So to give you a little bit more of a flavor of how this actually looks in the portfolios, I'm going to start with kind of a brief overview of each of our external managers and what they are doing to address ESG issues. So starting off with Visio, this is a new inclusion in the portfolios. So we've just recently done the due diligence and onboarding, and they have a really robust process to integrating ESG into their portfolios. They do this during the valuation process, and they also have a very detailed risk assessment procedure where they analyze a number of ESG risks and look at that before making any investment decisions. They're also very active investors, and the table on this slide shows some of the ongoing engagements that Visio is active with at the moment, and then they also do submit their proxy votes on an ongoing basis. Then we also have some equity mandates managed by Coronation. Coronation is a very active owner as well. They engage with companies within their portfolios quite a lot. The table on the slide just shows how many engagements they have, they have done in 2020 and 2021. And I just want to highlight one. This past year, they sent 90 letters to the boards of South African listed corporates, requesting them to comply with the TCFD reporting. So TCFD is the Task Force for Climate-Related Financial Disclosures, and this is a global best practice way of disclosing your climate risk. And so that's a really great move. It would be great if South African companies could disclose their climate risks better. So a really exciting step in that direction. Then we also invest with 91, and they are also a very active owner of the shares in their portfolio. They engage with companies and very actively analyze the ESG risk and opportunity within their portfolios. They have a strong ESG team that works well with their investment team. So they have quite detailed analysis of kind of their ESG performance and risk, which is what you're seeing in those charts on the slide. Then we also have ABACs within the portfolios. They also manage an equity mandate, and they are once again very active owners. They incorporate ESG in their investment evaluation. So they have a scorecard that they use, and that's part of the kind of evaluation of any investment that they are going to make. They also identify ESG themes and kind of try and make sure that the portfolio always stays on the correct side of the transition to a more sustainable world. And then ESG is also part of their risk management at a kind of individual stock level, but also at a portfolio level. So one of the key pillars of active ownership is to exercise one's shareholder right and vote at AGMs. So this is typically done by proxy voting, and the graphs on the slide show how many votes were cast over the past year by each of our active managers. Visio is not included in this graph because they are a very recent addition. And then the pie chart on this slide also gives you some more color as to the types of resolutions that managers voted against. So as you can see, it mainly relates to remuneration and capital structure. A few of the resolutions were also relating to environmental and social issues, but this is still quite a new type of resolution that we're seeing at AGMs, and still forms quite a small portion of the votes. And then on the passive equity funds that Sygnia manages, as I mentioned, we determine our votes here in collaboration with the active managers within our stable. And this chart just quantifies how many votes were cast on these portfolios over the past year. Then I'd like to move on to our credit and fixed income portions of the portfolios. Where we hold, well, where we delegate mandates to external managers, we once again hold them to account in a similar way as we do with with our equity managers. We do meet with managers on a quarterly basis, and ESG is a topic that comes up more and more often at these meetings. And then where we manage kind of credit in-house, which is kind of a growing component of the Sygnia portfolios, we include ESG as a part of the credit review process. And as I mentioned earlier, we also engage with our debt arrangers to identify and grow kind of the market for your more innovative instruments, such as green bonds and sustainability linked bonds. I'd just like to highlight kind of the green and sustainability linked bonds. I've put a chart there just indicating the size of our investments in those kinds of instruments. So we are, allocating capital to those instruments. It's still quite small as a proportion of the broader portfolio, and that's mainly because issuance in these types of instruments is still quite thin in the South African capital market. But we are very excited about the prospects of these sustainability linked bonds. So it's something that we saw come to market only within the last year or year and a half. And these are instruments that are a great tool for companies that are on the transition to becoming more sustainable. So one of the shortcomings with green bonds is that a company that is maybe still on their sustainability journey wouldn't be able to issue a green bond because you need to ensure that your projects are fully sustainable to meet the eligibility criteria of a green bond. But a sustainability linked bond operates in that the interest payments on this bond are linked to predefined sustainability goals that the company would set at the outset of issuing a bond. And this means that the company is incentivized to achieve those sustainability goals. And if they don't, their repayments will become higher. So while green and social bonds are really great, sustainability linked bonds do fill a bit of a gap that there was in the South African market, as they are available to all companies kind of on all levels of the sustainability journey. Then I'd also just like to mention that within the credit portfolios, we have always had a significant exposure to infrastructure, and that's through our government and SOE exposure. But we're looking to build this out and invest in more direct infrastructure projects. We've already started doing this with an investment in a water infrastructure project. And this is all in line with kind of the draft revisions to Reg 28, as well as the South Africa's National Development Plan and Economic Reconstruction and Recovery Plan following the devastation resulting from the pandemic. And where we are sourcing these projects, we certainly do look at environmental and social outcomes, and we do favor projects with very good environmental and social characteristics. Then moving on to the products with specific ESG outcomes or features. As I mentioned, these are mostly international products at the moment. And it enables us in our multi-managed funds to tilt the portfolios to align with some of the ESG opportunities that we see in the market. So definitely over the last 2 years, we've identified healthcare as a great opportunity. So during the pandemic, this has obviously highlighted how important healthcare as a sector is. But we also believe that, going forward, it's going to gain importance as population aging becomes one of the dominant demographic trends of the 21st century. So our portfolios are tilted to the healthcare sector. This is firstly achieved with an investment in the Oxford Sciences Innovation Fund. Now, this is a fund that's not exclusively focused on healthcare, but definitely, healthcare is a strength or a strong component of this fund. So what Oxford Sciences Innovation is, it's also known as OSI. It's a private equity investment in spin-outs from the University of Oxford. So these are really exciting young companies that are kind of solving some of the world's most important problems right now, whether it's dealing with health tech, software, AI, carbon emission reduction. And over the past year, just to highlight some of the exciting exits from this portfolio. So one of the companies within OSI, it's called VACitech. It was involved in developing the AstraZeneca vaccine, and that listed on the NASDAQ exchange earlier this year. We also saw a company, Base Genomics, being bought by Exact Sciences, and one of the largest diagnostics deals in the UK. And then a company called YASA, which manufactures components for electric vehicles, was bought out by Mercedes-Benz. Staying with the healthcare theme, we've also launched a unit trust and an ETF, which focuses on the healthcare sector. So these funds focus on the top 150 largest healthcare companies in the developed world. They include companies such as Johnson & Johnson, Pfizer, Moderna, Roche Holdings, among many others. And then for the healthcare unit trust, we also include an ESG overlay on this fund. So basically what that means is that we would screen out companies that have ESG scores, peer-related ESG scores that are below a certain threshold. So we remove companies that do not perform well on ESG credentials. We also do engage quite closely with our data providers to improve the coverage of ESG reporting in the sector, because one of the biggest challenges right now when it comes to ESG investing is, of course, making sure that your data is transparent and complete. So this next fund is also relies on ESG scores quite well. It is the Sygnia iTrix S&P Global 1200 ESG ETF. It was launched this past year, and it's a broad-based ETF which is constructed to perform in line with the S&P Global 1200 index while improving on the environmental, social, and governance credentials. So the way this is done, S&P has constructed this ETF, sorry, not the ETF, the index that the ETF tracks, on a very similar basis to the S&P Global 1200 index. But it improves on the ESG characteristics by firstly excluding companies with involvement in undesired activities such as thermal coal or controversial weapons. And that's kind of the table that you're seeing on the slide, breaks down exactly which undesirable activities are excluded. Then secondly, S&P would construct the index and exclude companies without sufficient alignment to the United Nations Global Compact. So this is a set of normative principles relating to human rights and labor rights, as well as the environment and anti-corruption practices. Thirdly, S&P also undertake a risk analysis and may exclude companies based on significant ESG controversies within the media. And then lastly, they use their own S&P ESG scores to screen out the worst performing companies within each sector. So this slide shows the cumulative performance of both the ESG and non-ESG index. And as you can see that due to their very similar construction, they track each other quite closely. But on the next slide, I've kind of chosen to take a look at carbon metrics, and you can see how the S&P ESG index improves on its parent index, the standard S&P Global 1200 index. So yeah, if you look at the carbon metrics, you can see a vast improvement, and that's from those 4 exclusionary criteria I mentioned earlier. And that concludes the report back on our stewardship report, as well as the webinar. So I'm going to hand back to Eva now to address any questions. Thanks very much.
Thank you very much, Nikki. I see that there's only one question so far, The question is, are you able to show a risk and return scatter plot over 1 year and 2 years so that we can understand how much of the risk the peer group has taken in the short term to generate a significant outperformance over the short term? So I don't have the 1 and 2 year scatter plots with me. However, I have looked at the portfolios that are outperforming us over the shorter term, and I can confidently say that they do have a higher allocation to equity as well as property. So looking at the asset allocation, they would be further right on the risk return scatter plot as they have taken on more risk even over the shorter term, but I unfortunately don't have those graphs available. I don't see any further questions, but please do get in touch with us after the webinar if there's anything that you would like clarity on. And again, I want to thank you for taking the time. I know it's a very busy time of the year, and we will see you again in 2022. Thank you.